You famously coined the phrase irresponsibly long Bitcoin, which we all love and use, when price was much, much lower than it is now. Has anything changed with regards to your view or conviction?
No, I mean, my conviction is like happens to all of us. It just keeps growing. And it's not really just a function of price. It's a function of the amount of people that come into the space, the thoughts that's going on, the development going on. So, yeah, I'm still both irresponsibly long financially. I've not sold a single thing. And I'm irresponsibly long in terms of commitment to where this is all going.
So obviously, there's the trickle down effect from Bitcoin into Ethereum into altcoins, and you have had no qualms with saying that you're interested in Ethereum as well. Is that also still the case?
Yes. I mean, I've spent a long time trying to say to people, just because people got burnt in 2017 doesn't mean everything repeats. I mean, in the end, Ethereum survived all of that, as did several other projects. And it's a risk curve. We're just starting a whole space. And a risk curve in financial markets, a bond investor might go to corporate credit and then go to junk bonds, or an equity guy might go to, blue chips to tech stocks to emerging markets. It's normal. It's risk-adjusted returns. And when you go further out, in this case, it's the altcoin space, of course they're riskier. So of course you take less risk, unless you really know what you're doing and you want to commit to that. But generally speaking, you take much less risk. And the idea is you get compensated by the returns, but you may not get because it's risky. I mean, the word risk is a real word. It's not a one-way bet.
And how deep down that rabbit hole do you foresee yourself going beyond the, top 10 market cap
And,
or?
yeah, I mean, at this stage, I don't have the bandwidth. There's way too much to learn. And I don't have the ability to understand. I'm a macro guy. I'm not a stock picker. So therefore, I'm not a token picker either. Some people do exceptionally well doing that. We're seeing that with people like Jeff Dorman at Arca and, the guys at Delphi and stuff like that. Those guys figure out the ins and outs of every single token. I'm just not that guy. So really, for me, it's the top down. Where is this space going? Where are the opportunities? Can I broadly represent that view?
Now, I actually read that you started by training people in technical analysis, which I found really, really interesting because there's always the debate as to, whether technical analysis is a useful tool. I obviously believe so for various reasons, but I'm curious, where did you learn technical analysis? How passionate were you about it? And is it still something that you view as a useful tool?
So I got my first job out of university was a graduate trainee at a company called Dow Jones Telerate, which was the Bloomberg of the time. And I was supporting the technical analysis product. I didn't know what technical analysis was during my economics degree at university. I think it was a half-hour lecture, which is like charts don't really work, but some people use these. So I had no idea. But then they gave me this huge book, which was John Murphy's Guide to Technical Analysis of the Futures Markets, which it's now called Financial Markets. And I had to read it. And then I had to learn how to show people around this product called Teletrack, which was the charting product. I had no idea. And the first people I ended up interacting with was all of the famous prop guys from Goldman who ended up forming the Tudor office in London when they all left in the early 90s. And I had to teach them a lot of it. And then from then on, I just taught myself and realized that I was a very visual person. So it actually just helped me because somebody can say to me, what do you think about German bunds? I have no idea. Put the chart up. I've got an opinion, some sort of opinion, something more informed without knowing all of the fundamental analysis. It's very helpful. And then I learned over my career that all the macro guys, because we have to look at so much stuff across so many different parts of the ecosystem, that charts is where everybody starts. You start looking for the interesting charts and thinking, now all charts are really, it's not voodoo, it's just human behavior. It's just human behavior. Because basically, if you go into a crowded cinema and shout fire, 8 times out of 10, people will do the same thing. So it's probabilistic outcomes based on human behavior. And you can also see where it's come from, where people panicky, where people overconfident. It's not that complicated. But again, people don't like it because people want to treat everything as a science, and life is not a science; it's an art.
I absolutely agree that I view technical analysis as an art or a pseudoscience, I guess, if you want to be. But it's literally so supply and demand, support, resistance, all of these lines exist solely because it's where people place their orders based on their lack of emotional control, right?
Well, one of the great learnings for me was, I remember back in 2000, Microsoft was breaking its 50-week moving average. And I'm like, I didn't really care about moving averages. But what I realized at the time, everybody was dollar cost averaging into stuff. And basically what it meant is everybody looked back at their P&L and realized over the last year they'd lost money. That's what happens when you break the 52-week moving average, is everybody's lost money for a year. And that happened to be a psychological point where everyone's like, oh, fuck this, I'm out of this. Right. And they sell their Microsoft shares. And then you're like, yeah, I get it. Humans are humans. We're all idiots. We do the same thing.
Yeah, that makes absolute sense. So I want to talk a bit about stimulus, because obviously we just saw 1.9 trillion in stimulus. Now they're proposing in the United States a 3 trillion infrastructure, and an announcement that in April we will get yet again more stimulus. So I'm curious how that's sustainable and what your thoughts are on that plan.
It's absolutely sustainable for the government to do it and the central bank to keep financing it by the way that they look at the world. So they will keep doing this. This will not stop because, let's face it, I don't know what I would do being a central banker or a government official right now.
True.
You've got an economy that's totally broken. The stock market, we'll come on to that in a bit, doesn't really represent what's going on Main Street. So businesses are destroyed. If you go to the US, infrastructure is like third world. It needs to be upgraded. You need to create new jobs. If you look at the trend rate of GDP over the last 30 years, it's been falling because of demographics and debt and all. Somebody has to change that cycle, right? So are you going to just throw out the rule book, go for MMT? I get it. What else are you going to do? Austerity? Forget it.
Yeah.
So you're going to do something. So that is going to happen. And everyone's going to go inflation, CPI is going to go up, and it's not. And the central banks are going to declare victory. And meanwhile, suddenly you'll look around and the stock market's gone up another 100%. And the price of some of the commodities have, and the price of artwork, and the price of anything with a fixed supply asset. And then you'll realize that what they're actually doing is debasing the currency. The dollar won't fall because everybody's doing it. It's the value of fiat currency overall. This is what people don't get their heads around. They keep saying the dollar's going to zero. No. The Europeans are doing the same. The Japanese are doing the same. The Brits are doing the same. The Aussies are doing. It's a massive devaluation of fiat currency overall.
Which is interesting because at this very moment, we're seeing what some are calling a reversal, or at least a bounce in the dollar. And it's showing quite a bit of strength over the past few months, actually, if you look at it now, which, like you said, it seems counterintuitive to anyone who goes, well, print. How does the value go up? I mean, what do you make of this dollar bounce that we're seeing at the moment?
I've been fully expecting it. The US is the best performing market in the world. The technological rate of change in the US is probably faster than elsewhere right now. I mean, China's, Asia's doing pretty well, but it's sucking in the world's capital. Also, everybody's short dollars from debts. I mean, there's 13 to 15 trillion dollars that people are short. So if you've got a cash flow squeeze going on anywhere in the world, they're scrambling to buy dollars. We've already seen that in Brazil because the virus has come back to Brazil with a vengeance. The Brazilian real is now falling every day. The dollar, it's very hard for the dollar to go down because of this dynamic. It's 88% of world trade. Everything is priced in dollars.
Right. So it's really a measure of relative strength, not strength itself, right? As long as you're doing better than everyone else, it will continue to rise, even if you continue to print and you continue to inflate.
Or the world goes to shit as well. And then people go to dollars because it's safety. So it's called the dollar smile. When things go well, people go to dollars. When things go badly, they go to dollars. When the world is kind of muddling through with, the US growing at 1.5%, the money tends to flow out of dollars and goes out the risk curve and goes out to emerging markets and other places. So, so if you're a government or a central bank and you're debasing your currency, for what it appears to them is there's no real consequence, right? Because the dollar hasn't got trashed, rates don't go up, CPI hasn't gone up. So where's the payback? Now, the payback is for you and I because we can buy less housing with our income, or less of a share of the S&P or a company or whatever it is, less of a share of the fixed assets. And this exacerbates the 1% versus the 99, because the 1% can afford to buy assets and they go up and they compensate for the debasement of currency. But your income doesn't go up. So people who just live off income can't invest. They get proportionally less investing. So to give it a comparison, a baby boomer who was 32 years old in 1980 could buy something like 60% more property, 60% more S&P, 60% more gold than a 32-year-old millennial now, with the same inflation-adjusted income. So it's the investment assets that have gone up, which is why the rich get richer.